In the recent quarterly conference call, SoFi CEO Anthony Noto left many investors quite surprised by his statements. What's intriguing about this is how the SoFi management team, led by Noto, initially approached 2024 with a cautious outlook, with interest rates hovering near historic highs and the economy showing signs of slowing down. They set a conservative forecast, suggesting reduced lending activities and anticipating a 5% decline in lending revenue for the year. Given this backdrop, the latest statements reflect a noteworthy shift in perspective that could catch the attention of both current and potential SoFi investors. Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But before that, alert, this is not a financial advice video. Let's break down what the CEO shared and how these updates mark a substantial pivot in SoFi's strategy. One of the main highlights Noto discussed was the company's shift toward increasing fee-based, capital-light, and lower-risk revenue sources. In the third quarter alone, SoFi's fee-based revenue reached $174 million, accounting for about 25% of their adjusted net revenue. Impressively, this segment has surged by 65% compared to the previous year. Specifically, their loan platform business saw a record-breaking performance, with fee-based revenue growing over 5 times to $56 million. Their interchange revenue also saw strong growth, doubling year over year. SoFi's management team further highlighted that the company's overall performance for this quarter, as well as the first 3 quarters of 2024, has exceeded their initial expectations. Due to these positive results, SoFi upgraded its forecast for the remainder of the year. While the initial prediction was for lending revenue to decline by at least 5%, they now anticipate it to stay flat or possibly rise. There's even a chance it could increase by 5% or more. This change marks a considerable difference from the earlier cautious tone, as it's a shift from expecting a drop to potentially seeing growth. This achievement has no doubt strengthened confidence in the company's ability to navigate the current economic environment. Another point Noto emphasized is SoFi's record-breaking $6.3 billion in loan volume, which contributed to an impressive $392 million in adjusted net revenue, up 14% from the prior year. This level of performance across various lending products demonstrates how the company has continued to grow even amid economic uncertainty. However, here's where my opinion diverges slightly from SoFi's official stance. The CEO asserted that SoFi has become battle-tested and that its achievements in terms of scale, profitability, and growth reflect its resilience across different economic cycles. SoFi's stance here implies they've shown an ability to grow regardless of broader economic conditions, whether during expansion or in times of downturns, including potential recessions. Essentially, Noto suggested that SoFi can sustain growth, whether the economy is booming or slowing down, which might sound overly optimistic to some. To explain why I hold a slightly different view, let's take a closer look at recent economic events. Although the pandemic brought an economic shock, it was relatively short-lived due to rapid government responses and financial stimulus programs that mitigated long-term unemployment and widespread financial hardship. The fiscal policies, combined with temporary changes in student loan repayment, provided a buffer against the typical impact a prolonged recession would have on consumer finances and default rates. This environment allowed SoFi to weather these challenges in a way that might not reflect a typical recession scenario. In a more extended economic downturn, the reality tends to be more complex. Typically, as unemployment rises, individuals rely on their savings to cover expenses, and eventually, many may face challenges meeting financial obligations. This often leads to increased loan defaults. But during the pandemic, default rates reached historic lows rather than climbing, which is unusual and largely due to those temporary government interventions. This means that while SoFi has navigated tough times and deserves recognition for its achievements, they have yet to experience the kind of downturn that could truly test the company's endurance in a prolonged recession with sustained high unemployment. So in my opinion, investors shouldn't feel entirely assured that SoFi can thrive under any economic condition just yet. While the company has certainly made strides and is well positioned, it hasn't yet had to manage through the kind of prolonged economic decline that typically impacts a financial institution's bottom line. A period of sustained high unemployment, rising default rates, and diminished consumer spending could test SoFi in new ways. If and when SoFi navigates a downturn of that magnitude and demonstrates resilience by continuing to grow, then I would agree that they are indeed battle-tested in a more comprehensive sense. None of this diminishes SoFi's achievements in 2024. The company's strategic pivot toward fee-based revenue and capital-light income streams has paid off significantly. I continue to believe SoFi stock is on a positive trajectory, and I remain optimistic about its future. However, I think it's prudent for investors to maintain a balanced outlook. The company's current success is noteworthy, yet true resilience in times of prolonged economic hardship remains untested. Noto's confidence in SoFi's ability to withstand any economic environment may be a bit early. To sum it up, 2024 has turned out to be a far better year for SoFi than even its leadership anticipated at the start. The results underscore the adaptability of SoFi's business model and the progress they've made in shifting toward fee-based revenue. Still, it's worth approaching these claims with caution until we see how SoFi performs in a sustained recessionary environment. Only then can we fully gauge the company's ability to grow across the economic cycle. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.